Hello everybody, good morning. Thank you for tuning in to our second live Marketplace Finance webinar. For those that don't know me, my name is Jean-Pierre Gortan and I'm the Marketplace Finance National Manager for Partner Acquisitions, and I'm going to be joined by my National Manager for Partner Relationships, Zoran Petkovski. So let's not waste any time and get Zoran straight on. Zoran, good morning, mate.
Good morning, Dino. How are you going?
Very good, mate. Very good. We've been extremely busy over the last few months, so it's great to bring some further value through these webinars.
We certainly have been, mate. So it's a pleasure to be back on our second live broadcast on LinkedIn, mate. Very good.
Yeah, it's awesome, and we are also streaming off YouTube as well for anybody that is on YouTube and is watching. We are streaming off there as well, but. It was great to bring the first one where we had our webinar around growing your business with Marketplace Finance, and we had one of our co-managing directors on there, Matthew Johnson, as well as one of our sales associates, Isabella. And we covered all around what Marketplace does, how we add value to our partners, and all around our operating rhythm, I should say, which was fantastic. And Zoran shared some great tips around how you can use our services to basically take your business up to the next level, which is fantastic. So, but today, Zoran and I are co-hosting Demystifying Development Finance, and we thought we'd bring on one of the best in the industry. Well, I personally think he's one of the best in the industry. He thinks different. He's got a wide-ranging mind when it comes to development finance, which is fantastic, and it's exactly what you need in that space. So let's get him on the show, our co-managing director for Marketplace Finance, Jean-Pierre Gortan. Jean-Pierre, good morning.
Morning, guys. Thanks for having me. Pretty excited. I was in the audience for the last one, and yeah, always nice when we can add some value to the network.
Right, absolutely, and it's good having you on. It's good continuing these live webinars to bring through to people, and we will be bringing them every month, as we mentioned last time. So really show some value that we've got on there. But for anybody that is watching, before we jump into some questions for Jean-Pierre around development finance and what to do about it, if you have any questions, feel free to drop them in the comments. Let us know where you're going from. I noticed we've got a few comments coming in from people, it seems like all across the globe, as well as hopefully people watching from Australia with some of our partners. But we do have some from Indonesia, Papua New Guinea, Canada, and we do have one, South Australia. Amanda is joining us from SA. So there you go. Hopefully you're all out of lockdown now, Amanda, and traveling well in SA. But we are going to share one of a slide as well that we've got on. And as well as that one, I want to ask JP if he can talk about the first slide and these points, which has probably become extremely important throughout this year, and seeing a little bit into the crystal ball for next year and beyond. So Jean-Pierre, can you talk to us a little bit about those areas on the screen?
Yeah, absolutely, Dino. So I think it's important whenever we sort of do these style of sort of webinars and sort of educational things, it's good to set the context. And I think that whilst this slide isn't necessarily about development finance, I think it's important to sort of talk about where we are, where we've come from, and probably where we're going as best we can imagine. So obviously, for our South Australian viewers, they had probably the world's shortest sort of full lockdown, the 3 days that they were under. But it's good to see Victoria has now come back out, and I think what that's done for the Australian economy, you can't sort of put a price on that, because it is right in time for Christmas. It's probably right in the time for retail to sort of get that sort of run into the big spending season. And I think if anything, it's emotionally, it's an amazing thing for everyone in Australia to be one community again. If only we could get Palaszczuk to agree, everything would be great. So having said that, Europe and the US are very deep into their second wave. I know the US is throwing sort of numbers of a couple of 100,000 a day at the moment, which is unbelievable, considering we've had 5,000 or 6,000 in total. But having said that, more locally, we now the unemployment rate hasn't been as high as everyone had predicted. They were all talking 10%. I think we peaked at about 6.9. But there is an expectation that when JobKeeper version 2 ends in March, that possibly could rise. But there was some press yesterday that said that because of JobKeeper and all of those measures the government put in place, about 700,000 jobs was saved. So it would have been well in excess of 10%. we probably still expect. I know Alan Joyce came out yesterday and said that if anyone is to fly internationally on his airline, they'll have to be vaccinated, which is an interesting tact. We'll expect the borders to be closed until probably early 2022. Historically, last time I was on the Ausbiz channel a couple of weeks ago, and that was the first Tuesday of November, where the government the RBA has dropped rates to a historical 0.1%. What that probably means for us is it removes the monetary policy as a tool for economic growth. We are basically going to be stuck with this for a little while, and probably it's going to be difficult to sort of get to use that policy in any meaningful way over the next few years. Historically low interest rates. So residential construction is expected to remain subdued. A lot of the construction in Sydney and Melbourne has been sort of driven by population growth, which, as we're all aware, that's unlikely to happen. We're actually probably seeing quite a lot of population sort of moving to regional town centres. Every second person I speak to in Sydney is moving to Byron Bay. So there might be a little bit of a growth spurt there. But that provides the context. So what does that actually mean for developers today? Like what types of construction funding is available? So it's one of those. It's one of those things that, much like in the sort of the lead up to the COVID in 2020, there was actually quite a lot happening in the construction space. Rates were low. There was quite a lot of activity. Developers were going well, and so where have we ended up? So no upfront pre-sale construction was very popular with the non-banks, heavily participated by people like Latrobe and other private players. They effectively stopped as a result of COVID. A large number of these players were concerned about asset values, so where the end product was going to end and what the demand was going to be like. And if unemployment was sort of north of 10%, then we would expect that property prices were going to sort of stagnate, if not fall pretty heavily. So this is now generally coming back. Albeit at a slightly lower gearing ratio. Historically, we're probably at 65 plus. Now 55 to 60 is really where people want to be. Build to rent, you'll see on the graphic there on the left corner. Build to rent's really a new asset class to Australia. It's actually quite popular in the US and in Europe. Effectively, a developer will build and design a project specifically for the purpose of renting it out. It's probably not going to gain a huge amount of traction locally because the government incentives required to get it done through tax credits or things like that don't exist. So the metrics, the returns for them aren't really going to sort of spur a lot of demand in that sector. And then probably the most popular one that has been available over the last sort of 5 to 10 years has been the traditional build to sell, which is a developer getting pre-sales, approaching their local bank, funding a project, and sort of moving on. Whilst pre-sales at the time were easy to achieve, it's almost impossible at the moment to achieve a reasonable amount without heavy discounting. Although the banks are still working in this sector around that sort of 80 to 100% coverage, but not many projects can get that. You have to be a pretty special project to achieve those sort of pre-sale numbers. Mid-scale projects, they're funded by people like Latrobe, Zaga, Asset Line, Centaur. There's a lot of players in this space, and they're sort of funding in that sort of 30 to 50% mark quite comfortably, and sort of giving you that 60-65% gearing, maybe even some at a higher level if you've got a good number of pre-sales. And larger scale players include Qualitas, Metrics, Gresham, and the like that are sort of playing in this space. But they've sort of created this hybrid, part pre-sale, part build and hold type arrangement. So it's good to see the players are helping the development sector continue to move along by not sitting on a policy and saying this is what it is, and they are trying to get transactions done. I think that's important for developers everywhere. And probably the last one, and it's getting a little bit more popularity. It was big sort of say 10 or 15 years ago, but mezzanine finance behind a major bank. Our office ourselves, we're writing quite a lot of those. Probably every third transaction has some level of mezz on the back of it. it historically was to achieve that higher level of gearing, but now it's almost become a better cost option when you combine quite a high-priced mezzanine facility with a very low-priced bank facility as a blended rate. It actually is cheaper for a developer and on better terms than going with the whole transaction to a non-bank player. So where that's achievable, that's definitely a good option.
JP, to interrupt, is that potentially because of the trying to fill the shortfall with the MES facility, given the lowering of the LVRs or the requirement of stricter policies from the lenders traditionally?
Absolutely. So historically, a bank, we'll take CBA for example. 5 years ago, CBA would have done 80% of cost. You like that, whilst the policy probably still remains in writing form within the bank, they'd be writing very little at sort of more than 65 or 70% of cost, and that leaves a funding gap. So where a bank still has a good relationship with their with the client, then the lender will in some cases allow a mezzanine provider to sit behind them. That mezzanine is drawn fully and it runs through for the entire project. It's the first drawn and the last one paid out. So even when you take into consideration the anywhere between 12 and 16 or 20% that you might pay for something like that, because it's only a small portion of the capital stack, it actually works out to be a much cheaper option than say taking the whole thing to a non-bank. You might save yourself 20 or 30% of the interest in that fashion.
Makes sense.
Hey, JP, I wanted to ask around, we're seeing a lot of business, and there's a critical word around pivoting this year, whether it's hospitality, retail, whatever it is. Yeah, exactly. Are we seeing a lot of lenders pivot much in this space, particularly around construction finance, when it comes to what they've been lending pre-COVID and I suppose slowly coming out of COVID in Australia? Are we seeing those type of business pivot to assist the consumer base? What's it been like?
Well, maybe pivot for that is probably maybe the wrong term, because like a lot of them sort of retracted. Like if you they sort of they were a flower, and then they were really excited about the market, and then all of a sudden they just closed they closed shop. And slowly now that it's become apparent that Australia's done pretty well through COVID, and the property market looks like it's going to be a little bit more resilient than what people had expected, you've seen them sort of start to slowly go back into the market. So for argument's sake, say La Trobe was doing sort of stuff north of 20-25 million. They pulled back very, very quickly down to max loan sizes of sort of 2, but they've started to make their way back into the market. So it's no different to any other lender. They're all concerned. They definitely don't want to lose money, because obviously their business is predominantly built around trust and a good track record. And so for them, it was a prudent move. So it's good to see them now coming back, and I'd expect that would continue to sort of trend that way. What has happened though is a lot of developers have shelved their projects. They are also concerned for their own sort of safety and financial stability, and so a lot of them have sort of just shelved the project and said, well, we'll wait till the market has improved a little bit, or when we feel a little bit more comfortable with the market factors that we can't control.
Yeah, excellent. Yeah, it's probably a good point, and I think you're right. I think pivoting is probably not the right terminology I should have used. But before I throw back to Zoran, I know he's got another question for you, JP. I did want to say hello to a couple more people who's actually left comments. I know there's more people watching, as I can tell from my mobile that's sitting on the table. But Helen from WA, I've known Helen for numerous years, fantastic broker out there. Thanks for joining, Helen. Bronwyn Bale from Victoria, Amir, overseas connection of mine, and Ragat from Egypt. So, mate, not only are you going global, I suppose being famous in Australia, JP and Zoran, it's going global, this demystifying development finance. Yeah. And it'd be wonderful if anybody was in that space from overseas and wanted to leave a comment around.
I'd love to hear about the development space in Cairo.
It would be certainly a lot different, I would say. But Zoran, I know you had another question.
Yeah. Now, so JP, if I had a client sitting in front of me wanting to complete a construction of whatever the project may be, what sort of questions should I be asking the client? What is it that we need to know up front?
Yeah, yeah. So what one thing that everyone who's listening can take away from this is development finance is very formulaic. And so you can create a pretty stable sort of plan that covers 95% of the projects that you're looking to sort of help someone with. So if you, and Dino, am I right to say that the presentation can be shared at the end with any attendees?
Of course.
Yep. So effectively, there's really a number of areas that as a development sort of finance partner, you need to sort of ask the questions. So they're not. It's not rocket science. It's actually pretty logical. So the first one is, what are you building and where? Is there demand for the project? The project you're planning on delivering in the location that you're planning on delivering it? Is it regional? Is it metropolitan? Is it Sydney, Melbourne, Brisbane? I ask, like you probably this may be told to you by the borrower anyway, but what that actually means, it actually determines where and when you can finance this project. So if it's regional, most major banks and major players will finance regional projects, but it eliminates a lot of the non-bank players. They want a certain population amount, they want a certain location within a sort of major metropolitan center, and so that's actually very key to then determining where you're going to go. Then, have you developed before? It might sound illogical that if a project has good metrics, that it should be able to be financed, and that's probably the case. But if a new to the game developer has come to you, chances are you won't be able to get a project financed at a bank. It doesn't really matter how lowly geared it is. Most banks will require a certain number of projects in a similar size to have been developed, because they've learnt from experience that if first-time developers really have a hard time getting a project to run smoothly. Who's building it? Who's building it? So there are really two options. It's either owner builder or third party. There are some JVs, but it's still a third party builder. But again, like the second point, a developer needs to have a builder that has experience in this area. So ask for the capability statement. Can they demonstrate that they've done this thing before? And some lenders, if the project is large, will also ask for financials of the builder, so to show they've got the financial capability of actually running this project. The one that's logical, are you planning on getting pre-sales? If you are planning on getting pre-sales, it really determines what options are available, what level of gearing is available, which lenders you can approach, and a combination of the above would then determine whether you can go to a bank or not. So some major lenders will consider sort of hybrid, part pre-sales, part build and hold. But generally, if you're looking at sort of major banks, you'll want to be sort of sub 45% on the on-completion LVR to be able to get it done, and show that you can show rental income at the end to service the debt on a standalone basis. So, and then probably last but not least, and probably the most important part, is the construction cost metrics. Check that the project's feasible. What questions do I need to ask? So there's really a list of, I think if you just go to the next slide, Dino.
Whoops. Too much.
Yeah. So we really need to determine those factors on the left. So gross realization, how much is the total project going to sell for? So if it's 20 units, what's the sum total of the 20 apartments or 20 commercial shops or whatever it is that you're building? What's the site value? Is it what you paid for it? Is it worth more than what you paid? You've sat on it for 5 years or 10 years and you got an approval. And so that's a question you need to ask. What are the construction costs? So have you got a quote from a quantity surveyor? Has a builder provided a quote? And we'll use that figure. And then contingency, as a rule of thumb, is generally 5%, unless there's a reason why it's not. The site might be contaminated. It might be there might be a lot of rock. It might be below the water table. And so contingency is just there, not necessarily for you to use, but it's there for the bank in the event that there are unforeseen costs, so that they don't have to make another approval later. They're reticent to actually go and increase the facility at a later date if they don't need to. Professional fees covers things like consultants, engineers, all that type of stuff, quantity surveyor fees, etc. Statutory costs, council contributions and council and long service levy and things like that all fall under this bucket, as well as then You've got holding costs and marketing. So this is rates, land, water. Marketing might be a display unit if you wanted to get pre-sales and you wanted to spend $250,000 on a display unit. So you fall in this bucket. And then probably last but not least, the construction term and margin scheme. So to be able to create a project feasibility that allows for the correct amount of interest, you'll need to know the construction term. And generally, as a rule of thumb, you'll allow 2 to 3 months after that for registration, issuance of titles, and then potentially settlements if there are settlements for you. Margin scheme, for those that don't know what the margin scheme is, effectively residential property does not attract GST, so you only pay GST on the sold product, on the difference between the total sales price and the margin of the land. So if it's a $10 million gross realization and you paid $5 million for the land, you're paying a rate of 5% GST on the end stock. So that's the margin scheme if the viewers haven't heard of that term before. So what we do is then we prepare a feasibility like this, and if we fly across to the next screen, what program? Now that I've got all that information, what programs do I use to create a feasibility? Look, historically, most of the banks provide you with their feasibility in an Excel version, so you can muck around with that, plug all the data that we've just gone through once you've got it from your borrower. Estate Master is also available. It's actually very complex and requires a lot of, you need square meter rates, you need a whole bunch of things to create a feasible, a suitable feasibility through one, and it's probably for the people that want to do some sort of advanced feasibility modeling on any sort of projects. But if you're looking for a little bit of a cheat and you're an iPhone user, I use one that's available online for free. It's actually University of Sunshine Coast feasibility. You could throw in all that data that we gathered from the previous slide into this, and within a couple of minutes you'll have a feasibility sent to you by PDF, which you can give to your client and sort of muck around with that. So it's actually a really, really good one. So once you've prepared your funding table, you should be looking for sort of a 15 to 20% return on any project. If it's less than that, it would generally indicate that your construction cost might be a little bit high, your gross realization's too low, or and so the only way to sort of adjust that is to maintain that 15 or 20%. You'll adjust your land value up and down. So that's the site value that you'll adjust. Next slide, please.
JP, I've got a question from one of the viewers.
Yeah.
What are the types of reports needed for the construction loans and the costs associated with them? Are there any specific ones that we need up front in order to prepare the FISOs?
Yeah, look, you could, so if your borrower is at a very early stage, it's unlikely they'll have a valuation or a quantity surveyor's report. If they do, a lot of the information that you need to prepare a feasibility is contained therein. Even in the valuations, they generally they have to provide a feasibility for the bank. It's part of the requirements. So those are the two reports that you'll ask for. You can find other information on things like the approval that say in New South Wales determines how much you have to pay as a council contribution. So you can go and gather all this information, but it's a scary prospect if someone that's come to you and said, I want to borrow $10 million doesn't have this information accessible to them. So I'd be a little bit worried if they said, I don't know. So generally, if someone's going to do a project of any sort of scale, they would already have this information and they would have done their own feasibility on it. And so generally you would take that information and then sort of create it. But if you needed to, and it's definitely not, it's definitely happened to me where a borrower says, I have no idea. I've got an instance where a client has quite a large subdivision, like 300 lots. I have the feeling they've never, when they purchased a site, they didn't do a feasibility. So it's it's definitely not impossible, but uncommon.
Okay.
Alrighty.
So JP, after you've done the feasibility study, what's next? Obviously, it's on the slide, but talk us through it.
Yeah. So once you've got that data, you should prepare a little concise summary to sort of whet the appetite of a couple of lenders that you want to speak to. You should have a pretty good idea of based on the data that we sort of asked, those questions that we asked the client for in the first couple of slides, where would be most suitable for their project. So what you want to look for is a summary should be concise. You don't waffle. Don't give them more information that you want. Like, you can put a couple of photos in there, but don't get caught up on that, because, like we mentioned before, development finance is very formulaic. So it's all about the numbers. Only cover what's necessary, and, like I mentioned, most important parts of the project metrics. So a little bit of background on the borrower is enough. So you'll talk about, have they developed before? Is the developer, so is it a third-party builder? Are they experienced in this? When did they buy the site? What did they pay for the site? All those types of things. So those types of backgrounds are useful for the lender, but again, don't go over the top. The worst thing that you could do is grab a bunch of attachments from your borrower, forward into a lender, and ask them to see if they can make a deal out of it. I can guarantee you, bankers are busy right now. There's a lot of compliance, there's a lot of transactions. They're just going to throw it to the bottom of the pile. You probably won't get a response. Whereas if you go to the next slide, you'll see a short summary that this is pretty similar to what I would prepare on a transaction. No more than that, and you'll note this is for an $18 million deal. That's about as much information as they'll need to be able to determine whether it's something that they will like. So again, some small amount of background, borrower, directors, description of the project, address, the metrics that they're looking for, a loan to cost, the loan to gross realization, and probably the pre-sale coverage, depending on how you are. And if you know the lender, you can also include a little target pricing, which you're never going to pitch at what you think they'll give you. You'll always pitch a little bit lower, but this information here, I can almost guarantee you that any lender that looks at that will be able to quickly know whether it fits in their parameters or not, and you'll get a response saying, yes, I'm interested in moving forward, or no, unfortunately, it's not for us. JP, please move on.
Excellent. I think that slide's really handy. I think a lot of people would probably look at a concise summary when you were talking about it before I flicked to it, and would probably start expecting a 2, 3, 4 page document when it comes to that. But having that, I think, is extremely valuable, not only to the lender, but also for yourself, so you can keep track of what's going on and actually put pen to paper on it. Zoran, did you have I think maybe the last question for JP?
Yeah, no, I think this is probably a good segue into the next question in terms of additional information that you might need to be providing to the lender. So any supporting information off the back of this, or is this concise summary where we can stop? Or obviously along the way, they might be asking for additional information from the borrower or the sponsors themselves. So
absolutely. Look, so yes, look, as extra things that a lender will also want to ask for. So generally they'll ask for a client's asset and liabilities. They want to know that if the project does go a little bit off the rails, that they have the ability to then find some more money to be able to then sort of top up the project in the event that. So if all of their money is in this project and they have nothing else and they have no cash, it will cause you problems as far as the lender is concerned because of that liquidity issue. But I generally prepare like a little Dropbox with folders that cover things like the DA approval, the plans, the schedule of prices, the marketing information. Especially when it's a build and sell, but at a low level of pre-sales, the lenders want to know that they've engaged someone reputable as far as the marketing of a project is concerned. It's all in the delivery. So whilst you probably think that agents are like good agents are good agents, but there are definitely superstars in each industry, and so you can tell when they've got good strategies on offloading projects. And right now, if you don't have a good strategy, you've got nothing as far as the selling of projects. So there are lots of different ways. Like a lot of developers are trying to take advantage of like the home builder 25,000 and all these sort of local and state incentives that are coming through. So where you sometimes come unstuck is if you have a poor marketing plan, and then the lenders think, oh, well, this guy doesn't know what he's doing. So seasoned developers have that; they know that that's actually key to that project for them, and so good ones have it all planned out right at the beginning.
Yeah. You touched on some of the inexperiences there potentially for new entrants in this space. What are the other potential hurdles that you've sort of encountered, especially in recent times, JP, outside of lender appetite? What are some of the hurdles that we've seen in not being able to fulfill some transactions?
Probably my biggest frustration is the length of time that lenders are getting to an answer. You could be, well, like we had an instance with a major bank that we were waiting 5 months and it still hadn't gotten to credit because the banker was so inundated with work, and it just got to the point where we just had to pull the transaction and go somewhere else. And so it's a very frustrating time to be in the space that we're in. But if you've got good relationships with good bankers, then you generally get a good outcome. And so that's generally it. Valuers are also a little bit slow. Like, I think that they'd anticipated that their industry was going to fall off the cliff where no more projects are getting done, but I know that they're very busy at the moment. So look, I would hope that over the next couple of months, some of these lenders start to resource a little bit better. But overall, the market's pretty buoyant. So I think if you're a developer or a borrower or a broker that has a development client, generally, if the project has legs, you should be able to find finance for it. So don't stress too much. Don't stress too much.
Good news.
And that's probably a perfect note to start wrapping up this webinar. But and it's a perfect note to say, listen, if you are getting those complex deals out there and you want some assistance, that's what marketplace finance is all about, and that's what we're here for. So if you need some further assistance in knowing how to become a partner and knowing how we operate, feel free to reach out to myself. If you have or sometimes more of those complex scenarios to touch base on to see if we can assist, and if actually JP will be assisting with it directly, also feel free to reach out to Zoran as well. We're here to help. We want businesses to grow, and as I mentioned earlier, we want to help businesses take them to the next level, whether that may be through these education webinars or actually assisting with individual transactions. So here to assist. But JP, Zoran, unless you have any last words, I'd like to thank you very much. I'm not going to say Merry Christmas because we will be coming to everyone pre-Christmas again, and I'm going to get Zoran to dress up in a Santa suit. I don't think we will. Maybe we might, but hopefully our next one will be, as JP mentioned, if we can get Anastasia Palaszczuk to open these Queensland borders to New South Wales, we may be doing a full live webinar in head office down in Sydney, which would be fantastic. So I can go and visit everybody and we can go visit some more people. But gentlemen, on that note, thank you again for your time this morning. JP, thank you again for sharing your wisdom.
My pleasure. Thanks for inviting me.
Thank you, guys.
Thank you, everyone.
Thanks.
Bye-bye.
Thanks, everyone.